Okay, welcome. And today we're looking at knowing your numbers. Stop flying blind. So thinking caps on. Our time's precious, and let's make sure this is good for you. So two things for today. First, get to take notes. If you take notes, you'll take a lot more from the session. And also take part, answer questions or ask questions. You'll get a lot more from it also. So with that in mind, just on your pad in front of you, jot down, what do you want to get out of this session today? What's going to be a great use of your time? Put in the chat box if you want, take part, and let's get on with knowing your numbers. Having a bit of fun with numbers as well, hey? Excuse me, I'm trying to make numbers fun. So let's see how it goes. Okay, so let's kick off. So what's the challenge with numbers? The reality is that most businesses are struggling, and it's really just down to a lack of understanding with numbers. Wrong numbers, wrong interpretation of numbers. Too often gut feeling is used in business making decisions. And unfortunately, these days, margins are so tight in many industries that there's just no scope for error. So there's many numbers out there of how many businesses fail. 80% fail in 5 years, another 80% in the next 5 years. No matter what the numbers are, too many businesses are failing, right? So today we're going to look to see what we can do to make sure you guys don't, but more than that, you thrive. You use the numbers to be able to have a better business and create more profit and more growth, more life for you and your team. Let's move forward then. Okay, so you can see here, doctor will measure your physical health, have three important metrics. Think for a moment that you're running your business from the beach. Sometime in the future, you're on the beach or a destination of your choice, you're running the business. What are the three measures, the three key metrics you'd choose to be able to run your business? Just have a thought. Put it in the chat box. I may well just carry on with this, but I'll read out any suggestions that come through. Sales, yes. Number of leads, good, yeah. Gross profit. Gross profit's an excellent one, yeah. So some key metrics for your business. You can have other measures behind those, but what are the main points? And think about this as focus. Whatever you focus on will get better, okay? So if we can think about what the key metrics are right away. So why is it important? Why is it important for us to know our numbers? Understanding our numbers, what's it lead to? Okay, so tighter financial control, absolutely. Better business decisions, greater awareness of what's going on, potential risks and opportunities, proper examination of issues. You know, if we're just using our feeling, it's not always right. So if we're looking at an issue, then we can understand the facts behind it. Better cash flow management, absolutely. All of these. Get this going in the right direction. A little bit about what numbers are. I think we all know what numbers are. They're the international language of business, if you like. It allows us to communicate with our business, to make proper decisions. And the guiding thing here is that profit might be the route map, but cash is the destination. Cash is king. That's what we're after with this, okay? So let's look at what are the key reports, key financial reports. We're going to focus on 5 areas for you to focus on your financials and how that can improve your business, okay? So first of all, we've got the profit and loss statement, balance sheet, cash flow, budget and break even, and KPIs. So many businesses, many business owners even, only look at the financial statement once a year. I was just speaking to somebody who's not got his financial accounts, and his end of year was end of August. So if you think the first month on that year was September 22, and he's still not had the financial accounts back through. So we're potentially looking at something that's 12 to 15 months out of date, depending on how quick your accountant is. So what if you had a problem on day one? That's 12 to 15 months worth of that problem getting worse and worse and worse. So we need to be understanding the profit and loss statement. That's part of the challenge as well. Accountants speaking gobbledygook in a foreign language. So we need to understand what they're talking about. There's lots of different terminologies. We need to understand that too. And so we need to have a better understanding about all of these reports, all of these different tools within our business so that we can make them work for us. So let's have a look at the first one in a bit more detail. Profit and loss statement. So profit and loss account or management accounts, financial accounts, it's simply an accounting term for the story of your business, the trading during a given period. So I mentioned monthly, yearly, could be weekly, could even be daily, but it shows your business's income from sales, bank interest and other income, less its expenses. So let's have a quick look at a basic breakdown of it, okay? So on the top level, and you'll hear it referred to this as the top line, it's sales. Some people call it revenues, some people call it turnover, but it's all the same thing. This is what you're being paid for your service or your product. Now, we need to take off of that how much it costs us to deliver our product or service. If it's a product you're delivering, then you're going to have costs associated with that. That'll be your variable costs. Service-based industries may well have less, but they still might have associated costs. For instance, an estate agent might have very little variable costs, but they're going to be paying for software, things like Rightmove and stuff like that, which you could argue needs to go into variable costs. But traditionally, this is going to be the cost of the goods that you sold, COGS there, and it's variable cost. So this will go up and down with the amount of things that you sell or widgets that you sell. After that, when you take variable costs off of the sales, that leaves you with your gross profit. Gross profit is probably one of the most important numbers for you to measure in your business. You can't necessarily, you can impact the net profit, but ideally what we want is for you as the business owner to be taking more out of the business as things go, you know, with dividends, with wages. And so if we focus on the gross profit, that's a better indication because we're always comparing apples with apples. So gross profit you can impact through buying better efficiencies, systemizing the business, understanding your numbers, what's making profit and what doesn't make profit. Lots we can do with gross profit to increase your bottom line. So after that, we take off the fixed costs. Now, this is the stuff that you pay whether you make a sale or not. So think utilities, your rent, directors' salaries, pensions, things like this. And that's leaving you with the net profit overall. Okay, so let's just have a look at those costs and break down those in a bit more detail. Fixed costs, fixed expense, incur whether or not you have a sale. So this is what you'll be paying, whatever. It might fluctuate from month to month a little bit, but it should stay relatively the same. Now, a good suggestion is if you've got a bookkeeper, if not, then do it yourself, is have a review of all your expenses. Look at the things that you've had for a while. Have you reviewed them? Have you negotiated a better price? Aim for a 10% reduction in your fixed expenses. It shouldn't be where you spend all of your time, because if you've got time to spend on making more profit, your time spent in growing the business is going to be better rewarded. But you can aim for a 10% reduction in your fixed expenses and see where that takes you. Variable costs, again, there's more things that we can do with your variable costs. This is how much it costs you to buy your products and to give them to your clients. Okay, any questions on what we've got so far? If not, I'm going to move on to the balance sheet. You can obviously save questions for the end as well. So balance sheet. So balance sheet is the least understood of all the financial forms, and one of the two most important. So balance sheet provides a snapshot of the overall health of the business, and it's called the balance sheet because it balances the assets with liabilities plus the equity. So equity is the value of the business after taking off your assets and liabilities. So the balance sheet represents the overall financial worth of the company and shows the value of the business for that particular day it's created. So this is important because the profit and loss displays the result of the period, e.g. the week or the month, but the balance sheet tells you the story for just that day. Generally, cash and inventory and the supplier invoices will change on a regular basis and then affect the balance of the assets and the debts. So 3 parts to the balance sheet. There's your assets. So these are the things of value that you own: plant, equipment, land, cash. And then the liabilities. This is what you owe. So the loans, overdrafts, and notes. So the assets and liabilities, the difference is the equity or the net worth. This is the owner's stake in the business, the capital shares or retained earnings. Make sense? Good. So let's have a look at cash flow forecast then. So the cash flow forecast, cash flow, one of the most important, well, is the most important thing, and potentially the thing that causes the most problems. So cash flow is it's the money that's moving or flowing in and out of the business in a month. So although it does seem sometimes that the cash flow only goes one way out of the business, it does flow both ways. So you think cash coming in from your customers and your clients who are buying your product and service. If the customers don't pay at any time or the time of purchase, then some of your cash flow is coming from collections of the accounts receivables or the debtors. The cash is going out of your business in the form of payments for expenses like rents, utilities, monthly loan payments, taxes, etc. So the cash flow forecast is simply your best estimate of the cash flow weekly or monthly. You may even do it daily, depending on the type of your business. So I'm sure you've seen this before. Turnover's vanity, profit sanity, cash is reality, or cash is king. You can't understate how important cash is. So profit does not equal cash. Why is that? Answers on the postcard or in the chat box. So your profit on your P&L, on your profit and loss statement, it could include people who have not paid you yet. Depending on your terms, they might not be paying you for a period of time. So this will be your debtors, people who haven't paid you. Also, your creditors, that's who you're committed to pay. That's who you owe money to. Buying stock, taxes, and non-cash items, things like depreciation. So let's have a look at what goes into cash flow. So cash flow is the key to any business surviving. So it's one of the main reasons why 8 out of 10 businesses fail in the first 5 years, because they don't have an understanding of the difference between cash flow and profit. Or if they did, they didn't manage the cash flow well enough. So cash flow is like, think of it like the oil in the car. It's the lubricant to take the heat away and keep the moving parts moving fluently. So let's imagine that there's no oil. The engine will seize up and be destroyed in quick time. So the same goes with a business without cash flow. This is why every business owner should understand how to manage cash flow. It's the real life picture of the pounds going in and out of your business. Often owners spend based on the profits, if you like, but not the cash flow. So these are not the same. So let's have a look at what parts make this up. So first of all, we've got aged receivables. So you may be making a profit, but if you're not receiving your payments, it's not available for you to spend. Hence the importance of efficient invoicing and debt collections. Buying stock. So you may be making a profit, but if you don't have great stock control, you'll have all your money tied up in stock, and this starves you of cash flow and prevents the owner for investing in higher margin stock and quicker turnover stock. Also VAT and provision for tax. So you may have money in cash, is in the bank, but this is not necessarily profit. Therefore, you can't spend it. So a practical strategy for this is to set up a VAT account or a tax account so you're not tempted to spend it. So let's have a look at, so that's the 4 main cash sources, and then cash drains. Let's have a look now at the cash gap. Now, put in the chat box if you've got an understanding of cash gap, or if cash gap is something that affects you, and I'll talk us through what the cash gap is. So you can see the days along the bottom here from 0 to 120 days. And this represents the period of time either before we get cash or when we're paid the cash. So stock arrives here day 0. And we've got the stock holding until either we've sold it or we've made it into something that we're going to sell. And then we dispatch the goods, say day 60. And then we've got another 60 days potentially before we get paid for that. Now, if you've got narrow terms of beg your pardon, say you've got 7 days, it's not going to be anywhere near as much as that, but that's perhaps a strategy to improve your cash gap. But a lot of people are collecting their cash, or their average debtor days are nearly 60 days, maybe even more, 90 days in some cases. So that's 120 days before our cash is received. So, but our payables, we're paying for that stock within 30 days in many cases. So the cash gap is this 90 days from when the cash is paid to when the cash is received at 120. So that's 90 days when we've not got any cash. So we need to be thinking of ways that we can improve our cash flows so that we've got less of a gap and potential, and avoid those potential problems. So I won't have we'll put your ideas into the chat box, but let's go straight into strategies for shortening your cash gap. But get your ideas into the chat box and get you thinking. Number 1, so get partial or full deposits on the contract to be paid up front. So often, and this is the case with a lot of this, you might say, well, we don't do it. Our customers aren't used to doing that. It's not done in our industry. You don't know until you try it. Finish projects so they can be billed and invoiced right away. Projects can go on, especially if we're relying on another trade to jump in and finish their work first before we can get in. So if that is the case, then bill upon certain parts of the job. Bill and invoice immediately on job completion. Use delivery acceptance process on job completing. Systemizing billing and invoicing. So having a system for any part of your business just makes it a lot easier for anybody who's using it, and it makes it a lot smoother process, and that it's done consistently. And that's what we want. So if you systemize your billing and invoicing process, it'll be done a lot quicker, a lot more efficiently, and consistently the same every time. And then your clients or customers will get used to receiving the invoice then and paying it then. Complete the billing invoicing on a weekly basis. I would do it as soon as you get the job completed, but at least on a weekly basis. Again, change your terms. Just because everybody else does 30 days, 60 days, or at the end of next month or 90 days, doesn't mean you have to. And it doesn't matter if not everybody changes to 7 days. You may have some who stick in the mud, but as a standard, if you can get some people paying 7 days, or the majority of people paying 7 days, imagine the impact that's going to have on your cash flow. Send multiple invoices, get my teeth in, with increasing demand on 14, 30 and 45 days. Make sure as part of your system for debt collection that you're using telephones, not just sending invoices, but that's an additional thing you can do. Give a discount. We'll see in a little while why discounting is bad for your business, but if you're getting cash flow in, if that's what's important to you, then a small discount to encourage early payment is a good idea. Add collection interest to overdue accounts. They're borrowing your money. They're using your money as a free bank loan if they're not paying you. So why should you have to pay the interest on that? Let them pay the interest. Outsourcing with things like factoring can be useful in some businesses. Just be very mindful of that because of the additional cost that's going to cost you. It's going to eat right into your bottom line. So be careful with that, but it can be useful for some businesses. Reduce inventory by using low inventory trigger points, set minimum, maximum level and order just in time. That's what JIT is. Again, having a system in place to make sure that this happens automatically is important. Buy inventory on consignment and pay when sold, self-explanatory. Negotiate prices on large orders, but receive pay for inventory in gradual flow. So with any suppliers, we should be regularly negotiating better prices. And if you can agree a payment on gradual flow, especially if you haven't got room in your warehouse for that, that's great. And again, negotiate longer terms from vendors and use progress payments on projects to get paid during the job. So you've got a long job, as I've mentioned already, 2 months, say, or a month, then why not get paid halfway through or part way through? Good. So put in the chat box any additional strategies you've got for that, and I hope that's useful for you guys. Let's have a look now in a little bit more detail about the cash flow report, because I want to show you how to forecast your cash. I mentioned the benefit if you can forecast what your cash position is going to be in your bank in the next month, 3 months, 6 months, or a year. What benefit would that have to you and your business? What would that allow you to be able to do? Yeah, absolutely. So we're going to be able to plan the future, know when we can buy that next van, take on some more employees. So this is a simple cash flow. You can do it in different ways, but I'm just going to show you a real simple way of doing it. This pretty much mirrors a simple profit and loss or financial statement, because we've got their income, then a variable cost, gross profit, fixed cost, etc. So you can see here we've got the months across the top, and then we've got the different parts that we're reporting. You can do this weekly, you can even do it daily in some businesses where it's needed. This is just a monthly one. So see what's most useful for your business. What we're going to do is we're going to take what's happened in the last month and then predict what's going to happen in the next month. So let's imagine it's the 1st of February here. We've just taken the bank statements for January and we've put it in there. That's the actual. And we're going to guess what's going to happen for February, and we're going to put that in February here. We're going to guesstimate. And we're going to do this by looking at our order book, looking at what February was like last year, and guesstimating what we're likely to do in sales. Then what's the responding cost of goods sold stroke variable costs on that, what that means in gross profit, what our fixed costs were. You should know what your fixed costs are going to be for the coming months, because it's going to be very similar to what it's been already. Look also out for one-off payments, things like yearly, quarterly, or 6 monthly payments that you might have had in the previous year. Make sure there's none of those, because they wouldn't appear in last month's bank statement, but they might be coming up in the next month or two. So look back at the previous year to see if you've got any of those scheduled in. You don't want any nasty surprises when you're projecting your cash. So from here, we've got a a forecast or a projection of where we're going to be in the next month, then when February is over, you're just going to look and see where were we on actual against what we projected, and you're going to learn some lessons from that. Well, I could have projected better on the pipeline, on what we did do. We actually did more than that, and so on. So you're going to gradually, month to month, month after month, week after week, you're going to learn and be better at projecting until you can get to be able to project 6 months or 12 months into the future, which is going to have a massive impact on you being able to plan your business. Okay, so let's get back to those key reports. We've had profit and loss, balance sheet, cash flow, budgets, and break even. So let's have a look at the budgets and break even here. And I want to just jump in with something on markup versus margin. So just in the chat box, just put in there, what's the difference between markup and gross profit margin? Interesting. Yeah, we've not really got anything concrete there, and this is what confuses a lot of people. The thing is, we use one or the other. I'll explain how to calculate both, but what some people do is they get them confused. So they might price something with markup and then set targets around the margin, and then they find that they don't equate and they've made a lot less money than they should. So markup is what you put up on top of the cost of the thing that you're selling. So in this case, it cost £100 to buy the widget, and we've marked up by 25. So that's 25% markup. But that 25% is not, that 25, sorry, is not 25% margin. It's only 20% margin, because its margin is the margin of the total price. So the total price is 125, and 25 is just 25%, sorry, 20% of that. So dictionary explains that, which is markups an amount added to the price of something, the difference between the cost of producing something and its selling price. So an example here, like we had before, buy something for £100, mark it up by 50%, then you're selling it for £150. So that markup is £50 profit. But margin exists between the net sales and the cost of the merchandise sold. So the top price versus the sale price versus what it cost you to buy. So in this case, if we're buying for 100, but the margin was 50, then we'd have to have sold it for 200 to make 50%. Does that make sense? Cool. Okay. So before I get on to break even, I just want to talk a little bit about budgets, because I mentioned budgets just there. Budgets are, so this is a financial plan for the future. So a financial plan for the future, there, struggling with my teeth all of a sudden. So it's basically concerning your revenues, your sales, and your costs of the business. So we're basically setting out goals for the financial controls, things that we want to achieve. And the wonderful thing about human beings, about you, about the people in your team, are that we're designed to achieve goals. We love having goals to achieve and going for them. So when we set an idea about what we want to achieve for our sales for the coming year, we're much more likely to achieve that. So let's say we set some new sales goals for the next year. How do we base those? We probably want to base those on the previous year. If we've got nothing else to base it on, maybe we have a new marketing strategy, things that with aims that we want to do. We think we can generate a significant amount more revenue. But if we're just basing it on the previous year, maybe a 20% increase gives us something to aim for regards to a new sales target. With that will come relative relative variable cost or cost of goods sold, and that will give us what our target gross profit is. But we might have raised sales, and maybe we want to improve our gross profit margin to make more profit. So we'll have to think of strategies to hit that, but we have a better target in there. And then what are we aiming to hit for our fixed costs? Are we looking to negotiate better costs and maximums for people to buy to, so that we can have a limit on our fixed costs? So that's a budget. That's what the aim is. It's sort of like a financial plan for the business. And in that, I mentioned about setting targets, and we've got a knack of hitting what we set. And I want to bring that into break even as well. So break even. So let's just have a think about break even. What's the benefit of knowing break even? Well, if we don't know, then we're likely to, when we finish the month, week, year, whenever we're projecting our figures, we haven't hit a profit. So we want to know beforehand what we're aiming for. But also, if your team know that break-even point is this, we might hit our target by Thursday afternoon, and then everything else for the rest of the week is all profit beyond that. And especially if your sales team are bonus-led, then that's a great thing for them to understand. But going back to, we'll hit what we set, if we hit break-even, then we're likely to hit break-even. So we want to make sure we've included profit in that. So in this calculation, I'm going to show you how to set a break-even target, but include the profit that you want to make for that target too. So break-even BE equals FC, which is your fixed costs. Remember, this is the stuff that is just the things that you pay out month in, month out, your rent, utilities, things like that, plus the profit you want to make. So let's say that your fixed costs are £10,000 and your profit is £10,000. So we want to make £20,000 a month. Divide that by your gross profit percentage. So let's say your gross profit percentage is 50%. So let's put those numbers into the calculator. So 10,000 plus 10,000 is £20,000 divided by 50% gross profit margin means that our break-even point is £40,000 a month. So we need to have sales of £40,000 a month to break even and make that £10,000 profit. Does that make sense? Just put in the chat box if you've got any questions on that. Good. Sounds like that's good. And you can ask questions at the end also. So we touched earlier on in the session about about discounting. I just want to show you why discounting is so bad for your business. Hopefully you can see those numbers, and don't worry if you can't see all of them. I'm going to talk you through some specific numbers. Let's say that your profit margin, that's the numbers growing across the top, is 25%. And you're regularly discounting by 10%. Now, regularly discounting, if you're regularly discounting, by the way, then that's an indication that your sales team are doing a poor job. They haven't got the skills to sell what you're asking them to sell. A client of mine we spoke about this week, he showed me the discount on what their sales team was selling, and virtually everything had a discount on. That's ridiculous. What's the point of the discount if everybody's got a discount? You might as well just call that your new pricing structure. So it's just a sign, well, in my view, it's a sign that the salespeople haven't got the skills to sell. And then that's another video about how we need-based selling through questions, etc. But that can be fixed. So, but if in this scenario, your margin is 25%, you're discounting 10%, you need to increase your sales by 67% just to keep the same margin. 67% you need to increase your sales by just to keep the same margin. So imagine if you didn't discount by 10%, all the less work you'd need to do. Now, consequently, the opposite is very similar to increasing your prices. Now, why wouldn't we increase our prices? Probably the people who are most scared about increasing our prices are the business owner, the manager, maybe the sales team. And the fear is generally because we think that people are going to leave us. The reality is most people don't leave us because of prices going up. Most prices go up just naturally. And the people who will leave you, they'll be the people who are complaining about the price generally. They'll probably take up the most amount of your time and then probably make the least amount of profit for you. So they're your D grade customers, and they're the ones who you're probably better off giving to your competition anyway, because you're not making much profit on. So let's have a look at increasing your prices. Again, say that your profit margin is 25%, and we look to increase your prices by 10%. If you did, let's say you did lose some of your customers, you'd need to lose 29% of your customers for it to impact your margin. And let's say that you did lose 25% of your customers. You'd be making the same margin, but with a whole lot less work to do, probably lost the worst customers. You can then spend that additional time to go out and find more of your A grade customers who are going to give you a better return on your margin, on your money. So it just shows you, really think closely about discounting, the downsides of discounting. What could you do instead of discounting? So instead of discounting, how about giving somebody something of perceived value? So instead of discounting the price, how about offering a free service, or have this free widget, which the cost price is £50, but probably only costs you £16 to purchase. So it's perceived value of being worth a lot more than it actually is, or something where you can offer some time where it's less of an investment of money for you. So offer them something of perceived value rather than something of real bottom line value off of your profits. So let's have a look now at key performance indicators. So we've looked at these other 4, and then we're going to look at now key performance indicators. So what are key performance indicators, or KPIs? We hear this a lot. It's basically a measure of value that really demonstrates how the company's doing in that particular area, so that businesses can focus on improving that, see the results of their efforts in that area, and just brainstorm ways to improve that. So let's have a quick look about this. So you could have key financial areas, so revenue, profits. We've mentioned about gross profit being important, projected cash flow, equity, is the business gaining or lowering in value, and other ratios in your business. There might be some non-financial metrics that you want to follow as well. So it could be key activity measures. So let's say you're measuring the revenue, the goal is $1 million, but what's the activity that goes into that? To reach $1 million in sales in this department for this part of the year, then how much activity do we need to be making on a daily basis to achieve that? Put some science behind the numbers. If you don't know that, guesstimate and then work back from that, and then keep testing and measuring it and updating so that you get to a level where you do know what input goes into that output. Customer service measures. If we're doing new marketing strategies, we're going to need to make sure that our customer service is really nailed tight. So what measures have we got to make sure that that's good? Are we surveying our customers? And other key strategies on value. And we can also, obviously, we want to be measuring our individuals as well, the team. So those are the key areas that I wanted to cover today. Put in the chat box any questions you've got. Really, whatever you focus on will get better. So we've got here the Peter Drucker quote, which is what gets measured gets managed. whatever you focus on gets better. So if you pick the most important areas, let's say on key performance indicators, you picked gross profit, turnover, staff happiness, whatever the metric is that you want to measure, you can always have measures that feed into that in the background. But if you see those are in the green, i.e. those are performing well, then you know everything's well. You can always have measures in the background to review and deep dive into more detail if you need to. Excellent. So that's all for today. I hope that's been enjoyable. If you've got any questions, then please let us know. Speak to you soon.